Hi everybody, welcome back. I have one more video to explain some more contemporary monetary policy, which is quantitative easing. And so in the last few videos, I've talked about the money and banking system, monetary policy tools, and if you recall, the most common monetary policy tools are open market operations, where the Fed, if they're trying to stimulate the economy, they will buy Treasury securities to increase the money supply, decrease the interest rate, so on and so forth. Open market operations, the discount rate, and reserve requirements. And if you haven't seen, I have a few videos that they all go into a lot of details about all of those things. This is quantitative easing with an A. But in the current economic environment, also we had a kind of a similar economic environment during the financial crisis in 2007, the Great Recession, it's called. The current COVID pandemic and the associated recession, we've reached some of the total bounds of these, and actually now none of these is really possible to do as it would conventionally work. So recall that open market operations, these ultimately, the interest rate that it's affecting is the federal funds rate. And then there's the discount rate, and there are the reserve requirements. But to give you an idea of what's going on here, let's look at all three of these, starting with the open market operations. So like I said, it controls the federal funds rate. And the problem here is that the federal funds rate is zero. It's essentially zero. And let me just point out that almost every recession that we've had, going back all the way to the mid 20th century, every time there's been a recession, interest rate drops by at least 5% or more during that time. So the more recent ones, in 2001, we were up here, looks like maybe around 7 or so, and we ended up down around maybe 1 or 2. So that's at least 6%. Here we're up around 5, down to close to 0 again, 5%, and all these ones are even bigger. So monetary policy in the past has always used open market operations to decrease the interest rate and encourage borrowing to stimulate economic growth. Well, unfortunately, pre-COVID-19, we were only up at 2.5%. And unless you go into negative interest rates, you can't do another 5%. So we've reached our lower bound on the interest rate, on the federal funds rate. So normal, kind of conventional open market operations, they're not going to work. Let's try the discount rate. Again, during recessions, discount rate is dropping. But again, we're essentially down close to 0. We can't decrease the discount rate, the rate at which banks borrow from the Fed. We can't decrease the discount rate. So that monetary policy tool doesn't work. Well, what about reserve requirements? Will it be our saving grace? No, because all the banks, their reserve requirements are 0. It used to be different for different sizes of banks. Like larger banks have larger reserve requirements, but during the COVID-19 pandemic, all of these went to 0 as well. So lowering the reserve requirements is also not an option. So basically, the three primary monetary policy tools aren't going to work. And that's where quantitative easing comes in. And in the last video, I talked about yield curves and treasury yields. And so remember that we have maturities on one axis and the interest rate on the other. And generally speaking, with very short-term maturities, there's low risk, because if things are going well, in 3 months from now, there's not much uncertainty, not much risk. So if there's not much risk, I don't need to be compensated very highly for that. So I'm going to get a very small interest rate. And in fact, if we go up and look at some of these graphs, so sort of this is all pre-COVID, but following the last recession, we're down around 0 on the 3-month treasury. We're up around 2.5% on the 10-year treasury, although this has gone during COVID down below 1. Anyway, during normal times, low risk, low return is required. As we move out further, 5 years or 10 years or 30 years, there's more risk, so you need to have a higher return. Okay, now essentially what's happening with open market operations when the Federal Reserve is buying the Treasury securities, and that's increasing the money supply. Money supply goes up, interest rate goes down, cost of borrowing goes down, so people buy more things, consumption goes up, investment goes up, so GDP goes up. That's the idea. But like we said, normal open market operations don't work. Quantitative easing, it sounds like this, big fancy thing, but ultimately, the basic idea of quantitative easing is that, okay, here, if we're talking about 3-month Treasury securities, we can have a market. So in the past, we talked about open market operations as generally the money market. But in reality, it's usually short-term Treasury securities. I'll call it T-bills, Treasury securities. So example, 3-month. And so the Fed, they'll buy demand, supply 1. The interest rate is the price. And so the Fed, they buy more of these securities. In exchange, to buy those, they have to spend the money on them. The money supply, actually, they have to spend money. So the money supply increases, interest rate goes down. And so maybe it was something at like 0.5%, and now it's like 0.1%. So very, very small levels, and I mean, essentially you're down to, let's call it, basically 0%. So, and that's what happens. That's what happened. That's what happened after the Great Recession, 2008 to 2007 to 2009. It went down to essentially 0%. And that's what's happened again. It's now again about 0%. So this is normal kind of open market operations. Ultimately, quantitative easing is just doing the same thing, open market operations, but with longer term securities. Because if this is not yet at 0, there's still room for it to go down. So quantitative easing, fancy name, but the long and short of it is, and I guess the long of it is quantitative easing is basically just open market operations, but the Fed is buying longer-term assets. And so when it buys longer-term assets, okay, if, let's say, we're in a recession type period, the interest rates here are already very low, close to zero, but there's still risk as we move up. Well, quantitative easing, so, okay, let's build three. So this is kind of normal. And then during a recession is coming, what happens is the Fed reduces short-term securities and the longer-term securities stay the same. So the red is open market operations. But then we're hitting, basically 0% here. So there's no more wiggle room for the short-term securities. Quantitative easing is just doing this more for longer term. Let's do quantitative easing is just doing the same thing, but for longer term maturities. So now it's cheaper to have 10-year types of assets, 20-year assets, 30-year assets. And so the quantitative easing, it's still trying to do the same thing as open market operations. It's just doing it with longer term assets. Okay, yeah, and that's the whole idea. Fancy word, but basic concept. All right, that's going to do it, and that's going to actually wrap up the series of videos we have here on money and banking system, monetary policy, Federal Reserve System, and this quantitative easing, which is sort of a more conventional, let's say maybe contemporary monetary policy tool. Okay, yeah. And then we'll be moving on with the next series of videos. We'll be talking about financial crises. So it's all kind of a little bit related to this. And following that, we'll do a little bit on international trade. So thanks for watching, and I will talk to you soon.